This week, we take a look at the fallout from DeFi's first big bank run and look at how prediction markets have quietly turned into a multi-billion-dollar business. You've got platforms like Kalshi and Polymarket now processing record weekly volumes. But first, let's take a look at the price action. We're going to look at the big macro stories of the week. We've got the around peace talks, naturally. We've also got earnings from some major tech firms, including Apple, Amazon, Google, Meta, Microsoft. This is also month end when we tend to see some pretty big portfolio rebalancing coming from these large institutional investors. And you've also got some central bank meetings just for fun, including the Fed's decision on Wednesday, where probably not expecting anything major, but I think what they say and the tone is going to be pretty important. We're going to connect the dots on all these things to the recent crypto price action. Bitcoin is still trading above that huge psychological $75,000 barrier. Let's get into it. Welcome back, everyone, to the Coinbase Markets Podcast. I'm Dave DeWong, the Global Head of Research at Coinbase. And as always, I'm joined by Colin Basco. Lots to talk about this week, but let's start with the broad risk sentiment. It actually looks pretty good. I would say that, not crypto, but if we're looking at equity markets, for example, they opened a little bit weaker today after the AI stocks absorbed a negative headline coming from OpenAI. But overall, though, we're still trading pretty well. Like, I mean, some of this seems kind of unusual to me. Colin, I don't know what you think, but I think that it's totally fine that markets are ignoring any of the economic data coming in. Like last week, we got the March CPI print, came in at a pretty high 0.9% month on month or 3.3% year on year. And markets completely shrugged it off. They're continuing popping higher. Normally, I feel like this is an environment where everyone would reprice Fed expectations. Markets would probably seize up a little bit. Plus, you've got the U.S. Treasury general account balance. It's been going up over the last 2 weeks. I think we've kind of hit a saturation point there. That's because of tax receipts, so it's not completely like out of the ordinary, but like it's now above $1 trillion. Normally, that would dry up liquidity, but all anyone cares about right now is the geopolitical narrative. So, Colin, you and I were debating this. Actually, it wasn't on this call, but we were debating this in private last week. You've been tracking the oil prices pretty closely. You were worried that oil prices breaking $100 were going to be a problem. I said it was not. And that's because my view is that the oil scare, for the most part, is over. And it's the reason for that is just like it's been a few weeks. We're all kind of numb to it. We kind of hit these peak gas prices to some extent, like peak fear at the very least. But unless you're telling me the oil prices are going to like $120 a barrel, $150 a barrel again, it feels like markets for the most part just kind of don't care. Like we were at $112 on Brent crude just yesterday. Markets were totally fine. Keep me honest here. Is this what I said? I mean, did I say anything else that I didn't mention here? And how much of that energy shock premium do you think is still in the system when you look at this like cross asset vol or look at positioning in the markets right now?
Yeah, so I think the market is still being pulled in two separate directions. So in one case, we do have oil, which I do still think is flashing real macro risk, but I think the S&P is still being carried by earnings power, especially from the mega cap tech, as well as AI, financials, and very strong margins. So I think the cleanest way that I'd frame this is that the market is trading the Iran shock as a very serious, but still a contained oil supply shock. So I don't necessarily think that it is a full-blown recessionary shock at this time. And I think that distinction matters because if oil is elevated because the market is pricing a temporary geopolitical risk premium, then equities can look through it. But if oil becomes a sustained inflation or margin and demand problem, then that's a very different market. So the current reality is that the traffic through the Strait of Hormuz has fallen sharply. And there are only a handful of ships that are actually crossing versus the normal 100 plus daily transits that would happen on average. Right now, it's under 10. So I think oil is still continuing to behave like a choke point risk asset. But the bearish counterweight for oil is the ever pressing possibility of diplomacy. So allegedly, Iran has floated a proposal to reopen the strait and end the war if the US decides to lift its blockade and end its aggression. Obviously, that hasn't really happened yet, but that does create a very binary risk premium because oil can stay elevated while traffic is impaired, but it can also gap lower very quickly if the market decides and starts to price in the possibility that the reopening is credible. And once it is credible and the actually goes through, then that would result in most likely in a gap lower in oil, in which case equities would rally significantly. But it seems like people are still sort of pricing in that in ahead of expectations. Also, there's also the fact that equities are essentially pricing in the probability weighted earnings path after the potential diplomatic off ramp. And I think that's also supported in the latest earnings data. So essentially, FactSet does a great job in terms of aggregating a lot of the earnings data and breaking down why exactly across the industry, how different companies are performing, how their margins are doing, how their revenue is doing. And the latest data shows that with admittedly a relatively small percentage of S&P companies have reported so far, but out of those companies that are reported so far, 84% have essentially beaten EPS estimates, 81% have beaten revenue estimates. But the most important story here is the margins. And in terms of margins, the S&P's blended first quarter net profit margin ran around 13.4%, which is the highest it's ever been since FactSet began tracking that metric in 2009. So overall, I think the backdrop for equities, especially that mega cap component, which is like that very small centralized component of the S&P that's driving like most of the gains now in the S&P, are essentially just outperforming. So I think that's another reason for why we're seeing that component of the market just outperforming equities doing well, despite the fact that oil is still almost at 100. It's still in the mid 90s. But yeah, I think that's the main driver there.
Yeah, that could be right. I feel like this market is more about equity premiums being driven more by like multiple compression, multiple expansion. And in large part, I think that's because some of the themes that are still lingering, like AI, for example, are still there in the background. And I feel like that's what we're going to test this week with some of these earnings statements. Like, does CapEx spend still matter? Is that what people are kind of focused on? Obviously, we got like the headline from, what was it, Allbirds like last week about like transitioning to AI. So that is still clearly a relevant market theme. Maybe we should have changed this podcast name to the Coinbase Markets Podcast.ai, see how many more subscribers we get. But I feel like that's kind of like the nature of these things right now. And honestly, I don't think either of us, probably no one really has an edge on what's going to happen with this conflict in Iran. And I still it's still very headline driven. That's kind of determine everything. My base case for what it's worth, and again, like I said, no edge here. Like, I think that we're probably going to be wrapped up in the next 4 to 5 weeks. Probably next month at this time, we're not really going to be talking about this anymore. But that doesn't necessarily mean that, we won't escalate, that there's going to be peace talks. Like, I feel like it's a coin flip right now in terms of which one it's really going to be. And depending on that, I think that's how market's going to react. So I think, I still am very cautious about what's going to happen over the next, say, 2 to 4 weeks. Like I mentioned on this call, like last week, for example, that all the Marines coming in from other places, like just landed probably like today. Actually, I think they're all there now. So that means that this could either be giving the administration an edge in these negotiations, or there's real potential for conflict or escalation of the conflict. So no idea. But we talked about crypto being surprisingly resilient relative to equities and other assets during this conflict. That's still kind of true to some extent, but equities has kind of pulled ahead more recently. But you also wrote about the current setup for Bitcoin. Like, how meaningful is all of this to Bitcoin's latest rebound? Like, what does it say about real spot demand versus speculative trading here?
Yeah, so I do believe that the latest rebound does look more meaningful than it has in quite some time, but I still would frame it more of a test rather than a confirmed regime shift. The reason I think it matters is that the move has come from essentially two forces working together. On one hand, you have real demand is improving, and on the other hand, you also have the supply side, the float looks tighter. And on the demand side, we're seeing US spot Bitcoin ETF flows have picked up significantly. Trailing 7-day inflows reached pretty much the highest level that we've seen this year. On the supply side, digital asset treasury buying and likely long-term holder accumulation has moved a lot of that supply into the hands of more persistent holders. This has been an ongoing trend. A lot of the digital asset treasuries, particularly Strategy, has been buying up a lot of supply, and they tend to be more persistent holders. So on the supply side, I think that's a good story. Now, the combination matters because I think Bitcoin often can rally on a bunch of different parameters. It can rally on thin liquidity, it can rally on leverage, it can rally on short covering. But for a long term actual reason for it to move, I think in terms of a sustainable move, we often probably want to see real spot demand behind those moves. And here, ETF inflows matter because they're a more stable and institutionally scalable source of funds and actual, sentiment and demand buying rather than that fast moving speculative component if it's leverage driven. Now, that being said, I don't think the rally was entirely driven by ETF flows alone. We did see a pretty meaningful spike in short liquidations as Bitcoin approached 80,000. And at first glance, some people will be a little bit, dismissive and just say that this is just a short squeeze. I think that's a little bit too simplistic of analysis in crypto. A lot of the major trend reversals that we've seen have actually been ignited by liquidation driven moves. So essentially forced buying from shorts isn't always a bearish sign, in my opinion. I think it can also often be the spark that pushes price through key technical and on-chain levels. And I think that can get a lot of bots and a lot of people buying with real spot demand in terms of igniting an actual momentum driven move. Now, that being said, I don't necessarily think that this is the case for a long-term durable rally quite yet. I think there are other key technical levels that need to be broken. The main one here is the short-term holder cost basis, which is sitting around 80,000. Essentially what that cost basis is, the short-term holder cost basis is the average on-chain acquisition price for wallets that have held coins for less than 155 days. This level in particular matters because these short-term holders are usually the ones that react more aggressively to price moves than longer-term holders. They're essentially the marginal buyers and sellers that are shaping short-term market structure. They're the ones that are moving in and out of position and actually influencing the short-run liquidity environment for Bitcoin. So what you see, generally speaking, is in a healthy bull trend, the short-term holder cost basis often becomes support. And then in a bear trend, it becomes resistance. The intuition for this is pretty simple. Recent buyers, generally, when they get back to break even, they're less inclined to panic sell in a bull trend, and new demand often will show up around that same area. But if we're in a bear trend, that level can act more as resistance. People who bought higher and sat through the drawdown may use that first rally back toward break even as the opportunity to exit. Nobody really likes admitting that they panic bought, the local top, but no one really cares, right? Like in terms of profitability, whether or not they'll hold through significant drawdowns is questionable. And when the opportunity to get out, break even, presents itself, then that's where you see that behavior sort of reassert itself. So I think that's why 80,000 matters so much. It's also a huge psychological level, by the way. And if Bitcoin can reclaim and hold that area, then I think the move will start to look more like less like a bear market rally and more like a transition towards a constructive trend. That being said, what we're seeing right now is a short-term rejection of that area. And the on-chain metric that I would look at in combination with these levels would be the spent output profit ratio. In plain English, the ratio just tells us whether coins being moved on-chain are being spent at a profit or a loss relative to where they last move. A reading above one essentially means that coins are being spent in profit, while a reading below one means they're being spent at a loss. The important point here is that ever since January, that ratio has stayed below 1, which essentially suggests that Bitcoin has been in a weaker regime where participants are more willing to realize losses and rallies haven't been able to fully repair sentiment. Instead, people are just selling in every single time that Bitcoin rallies, essentially the definition of a bearish rally. But the fact that the metric has been rising recently, plus the fact that we're testing these very significant levels, such as 80,000, which is a short-term holder cost basis, it's also a very important level in terms of pivot point market structure from a liquidity perspective. Both of those would suggest that we are at a pretty pivotal point in the market. If we're able to return and be able to confirm above those levels, I do think that would be confirmation for the potential move significantly higher, potentially to like 93 to 94. But that being said, right now we did reject, so I'd be cautious here.
Yeah, and for anyone who can't see that chart, we do have this on YouTube if you're watching on video, but we also published this in our last weekly market commentary. It's also in our Charting Crypto report, our chart and crypto report just came out also last week. This is our quarterly report where we talk about technicals in the market. For example, we look at the 4-year cycle, for example, 4-year cycle charts, what's going on with Bitcoin flows, other things. But definitely take a look on that. A few things we didn't discuss yet. The market is bracing for sort of like a super week. At least that's what I'm calling it, because I mentioned at the top of the show, we've got the Fed, for example, which, they've got the meeting this week, but they're expected to hold rates at 3.5%, 3.75%. Jerome Powell will be presiding over this. I think it's his second to last meeting, not his last meeting per se. But this will, be like one step closer to seeing Kevin Warsh in there. And Powell has said that he's probably going to stay on, even if he's not going to be Fed chair after May 15th. He's going to remain on the board. And I think that's going to be interesting because, that basically breaks with precedent. And we don't know how that's going to divide the board, whether that means that it's going to be more hawkish, more dovish, like how is it going to lean? I think it's just going to add a lot more variables to this. But, as we hit month end, a lot of large funds are rebalancing the portfolios. Like I said before, this is, one of the more higher inflation prints that we've gotten. The transition to Kevin Warsh is also kind of adding more complication. But you've also got not just the U.S.-Iran diplomacy, but you've also got like these earning reports coming from Microsoft, Google, Meta. Ultimately, like I think this begs the question of like, what does all this mean for crypto? I think that if we see that there's actual real progress towards a U.S.-Iran deal this week, that's going to envelop everything. I think everything else probably won't matter as much. But if that happens, the war escalates, then I think people are going to start really kind of like digging into like, well, what do all these earnings mean? I still think that there could be an opportunity for this institutional rotation into pure play crypto assets as a defensive growth alternative, because crypto, for the most part, it's just hanging in there. I mean, like it's, not doing gangbusters well compared to like what we've seen with equities kind of catching up, but just kind of staying the course, I think could be very meaningful for crypto. But there are a few idiosyncratic things. I kind of want to pivot and talk about what we just saw last weekend. So it wasn't like the most recent weekend, but the weekend before that, the Kelp DAO exploit. We didn't really talk about it much on this podcast. I kind of mentioned it with Scott Melker last week when we had this episode, but we wrote about this in the weekly. For anyone who doesn't know, wasn't paying attention to this, there was a $292 million exploit on Kelp DAO, triggered a liquidity crisis of sorts on Aave, which saw a $9 billion, $12 billion kind of like run on the TVL. We saw some major DeFi participants over the course of the last few days coming in. That was Consensus, Lido, EtherFi. They are all pledging a lot of money to a recovery effort for users affected by this exploit. But Colin, could you kind of just give us, broad strokes on like obviously the Kelp DAO exploit showed, manual audits are just not enough for some of these more complex DeFi structures, even not so complex DeFi structures. But, you hear something like this. Yeah, you got to think, well, we are in a different world now. You've got these advancements in AI. Like last week, we were talking about like the Mythos moment, because at the IMF spring meetings, a bunch of finance ministers, central bankers were all talking about the risk this kind of presents to markets for the medium term, or even not just markets, but to the world. And DeFi, historically, there's been this like incentive to like build fast, break things. But with, all of these major developments, how does a decentralized protocol kind of survive in a world where AI can just kind of like root out these exploits 24/7?
Yeah, I think the biggest risk isn't simply that AI will find these bugs. I think that's part of it, but I think the framing is a little bit too narrow. So the bigger issue, I think, is that AI is starting to compress the time between vulnerability discovery, the construction of the exploit, the execution of the exploit, and then laundering the money. So I think that matters a lot more specifically for DeFi, because DeFi is still treating security like a launch checklist. It's something to just get done, get the audit, publish that badge, ship the product, and then hope that, people in Discord stay calm. That is a pretty dangerous mismatch, in my opinion. I think attackers are getting more scalable automation with every advance in AI, and I don't think that trend is going to slow down. I think a lot of protocols tend to have pretty episodic audits, and they have pretty relatively thin treasuries, slow governance. A lot of these bigger companies and protocols are not making a ton of revenue in terms of if you look at the average daily revenue that a lot of these like pretty old um, protocols make on DeFi Llama, you'll see that they don't really make enough revenue to justify a lot of the costs, ongoing costs for security. So I think in terms of incentives, there's not enough of an incentive for a lot of these protocols to spend heavily in terms of infrastructure resilience. And I think Mythos really represented a capability shock in this context. There was a report by the UK AI Security Institute that said Mythos showed a pretty meaningful step up in cyber capability, including strong performance on expert level cybersecurity tasks and even solving pretty complex corporate network attack simulations in end to end in a lot of attempts. And this is highly problematic, in my opinion, because DeFi is very uniquely attractive for a lot of these attackers because of those reasons that I mentioned before. Also, you have the fact that smart contract code is public, money is visible, the reward is very quantifiable through a code logic, and then also execution can be simulated locally. So it's pretty easy to determine whether or not a lot of these exploits will work and what the actual profit incentive will be. So I think the risk is that primarily AI is lowering the cost for searching for these mistakes and also raises the baseline capability of mediocre attackers to be able to inflict really high amounts of damage. So I think that's one problem, but you also have another problem where DeFi security was already pretty fragile before. You already saw like a lot of headlines about ongoing attacks, like we have a hack every now and then, which results in billions of dollars of losses. So I think in terms of attacks, generally speaking, DeFi was already relatively susceptible, and AI just improves that ability to capitalize on the relatively lax security infrastructure in place for a lot of these DeFi protocols. So I think going forward, a lot of different protocols, if they are to really succeed, will have to invest relatively heavily and on an ongoing basis to be able to combat some of these newer capabilities that AI is showing it has.
Yeah, I think that's going to be the challenge for a lot of institutional investors who might be interested in DeFi, but they see headlines like this. And I think that ultimately they're kind of like, well, maybe DeFi is not ready for the amount of capital that could be unlocked here. Or maybe there's going to be some developments in decentralized identity or other things that's going to have like some sort of like universal KYC with like, I don't know, zero knowledge or FHE kind of on the background to kind of at least, allow people to interact without doxing themselves. But I don't know. I feel like there needs to be some kind of development here. And it might be kind of unfair, but like when you contrast that with like all the developments we've been seeing in, real world assets, for example, it just kind of like puts like what's been happening in DeFi in stark contrast. Like, just this week we saw like Western Union, their CEO announced that they want to launch a new stablecoin, US DPT, I think it's called. And it's going to launch on Solana. And, they want to use this as a potential replacement for Swift. Like this is, not the first headline we've been getting about this. There's been so many developments when it comes to institutions entering into the space, like what Ondo's been doing, for example, Morgan Stanley now, like, they're still early, but like they're putting a ton of capital into this. They're launching, they launched a crypto ETF. So I feel like now you're getting real like RIAs and other participants coming into the space. I feel like there's a massive contrast when we're looking at like some of the, I'll just call it unique disadvantages of DeFi compared to like what we're seeing in the rest of the crypto complex right now. So, it just feels like this is really, we're going into like a regulated approach when we're coming into crypto. And I don't know, maybe some people will be unhappy with that. Some people will, but like, that's kind of how I'm thinking about like squaring this circle. Last thing I kind of want to talk about today is prediction markets. Prediction market volumes have shifted from like this kind of like niche crypto interest. I would want to say like 18 months ago, like maybe 2 years ago. I don't think it was even that long into this like multi-billion-dollar global empire. Monthly transaction volumes have skyrocketed, obviously. Like maybe you can walk us through some of those numbers, but it doesn't feel like this growth is just about whale activity. It feels like you are really seeing these like unique participating wallets that are really kind of engaging in the stuff. Colin, we've talked about this before. This isn't a new topic for us, but like, What are you seeing right now? Because obviously geopolitical efforts are, kind of feeding into this movement. It's kind of evolved away from this kind of like degen, kind of like speculative kind of shop into like really kind of like real markets. Like, what are the trends you're seeing here?
Yeah. So as you mentioned, it's obvious that this is no longer a niche product anymore. We're getting billions of dollars in terms of even weekly transactions now. Weekly volumes are exceeding billions across these prediction volume platforms. And I think the biggest near-term driver tends to be sports. On Kalshi, sports plus exotics accounted for around 85% of weekly volume. Sports alone was around 74%. So it is becoming less concentrated in sports, but it still is the overwhelming majority of volumes. Poly market's a little bit more diversified, but still sports represents a ton of that volume. I think that matters because sports does change the product from a forecasting tool and like a media tool into like a daily habit loop where you have like these constant repeatable different events that people can essentially bet on. So you have like the NBA playoffs, the draft, MLB, soccer, etc. Elections tend to be a little bit more episodic. Fed meetings, periodic macro data happens on a schedule. So there are a bunch of different event contracts that can be generated. So I think it makes sense in terms of why these volumes are continuing to, go crazy. We also have like event volatility, just given the fact that the geopolitical scenario over the past couple of months has been pretty chaotic and has been relatively addictive in terms of people trying to predict what is going to be like the next crazy thing that happens in geopolitical conflicts or escalation, et cetera. So I think it makes sense. I think prediction markets are becoming like more of a live predictability layer for the internet. We had the integration with X as well. A lot of different media networks are trying to integrate with prediction markets as well to capitalize on that and to generate revenue from people's views as well. So I think in general, it makes sense why a lot of this is happening. Psychologically, I think it's really a great sort of contract in terms of being able to convert opinions into different tradable identities. You have your sports fans, you have political junkies, you have macro traders, crypto natives. All of these people have very strong views. Being able to have that social proof and a P&L attached to their view, I think is a very attractive thing to do. And also something that we talked about like a while ago that we haven't really talked about too recently was the K-shaped economy. And I think that also is something that is probably adding emotional fuel. And I think it will continue to add emotional fuel into the future. I wouldn't call it a main driver, but I do think it's a pretty underlooked driver for this. I think in terms of a bifurcated consumer environment that already exists, I think it increases demand for asymmetric payoff products, especially for people who feel that traditional wealth building channels are slow or inaccessible. I think this is one potential way where you're seeing, a lot of people floating on X, different arbitrage bots, pretending as if they're making billions of dollars. Obviously not, but like there are like it is attractive from that quick, like get rich quick money scheme perspective. And there's been studies that have been put out in terms of as the K-shaped economy becomes, more bifurcated in terms of the gap between the rich and the poor growing, the rich, will be able to, weather and be able to gamble relatively comfortably, whereas the other end, the poor, will seek more gambling style opportunities to be able to try and close the gap. It doesn't tend to work in reality, but it is behavior that we have seen grow as that gap becomes wider. So I do think that with AI, as we've discussed in the past, tends to make that gap probably grow wider at an accelerating rate. I think that will be an additional driver in terms of pushing up prediction volumes. So unfortunate trend, but probably a realistic one.
Yeah, I think that's a good point about the K-shaped economy. And I've mentioned this on the podcast before. I wrote about it a few months ago. But it's interesting because you bring up the K-shaped economy, and I kind of want to make a point here because I think a lot of people think that, this, kind of feeds into the idea of an affordability crisis, not just in the US, but in the world. And they're not exactly the same concepts, but they are related. Something to kind of point out, though, is that wage growth actually has been outpacing the cost of living in terms of like CPI, cost of goods, all these kinds of things. But there's two things going on. It's what's actually happening and what people feel it's happening, because when you go out there, things cost more. It doesn't feel great. So even if your wage growth is higher and you're getting paid enough to compensate for the costs of these goods and services that you're consuming, is psychologically you're like, no, but like I'm paying more, so it's not, like it doesn't feel like your wealth level is actually increasing. It feels like you're stagnating because of that. And I think that huge behavioral bias is kind of what's contributing. By the way, I think this is going to be the big topic for the midterms. And, this isn't a topic we're going to get into today, but pretty soon, like we're going to be hitting midterms in the US. And I think that this is going to be a major driver for not just what's going to happen on Capitol Hill and how like whether like the Senate or the House is up for grabs. I think polling currently suggests that we'll see a flip in the House, but not the Senate. But it's going to be really, really narrow. So I think that a lot of people believe this actually has an impact on markets. I kind of put a pin on that one because like we've seen that in previous midterms that coincided with rate hikes by the Federal Reserve. And I think that was probably the bigger driver. It just happened to be that happened to be like the midterm years as well. And so it looked like markets were doing poorly because of midterms, but really I think it was they're doing poorly because rates were higher and liquidity was drying up. But anyway, that's going to be a discussion for another day. I think it's a good place to kind of leave it. Huge thanks, Colin. Thanks to everyone who's been listening to the show. If you like this episode, please hit that like and subscribe button, and we will be back next week with another look at what's moving crypto markets. Thanks, everyone, for listening.
This corresponds to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Our results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third-party investment strategies or digital assets or any website or content related thereto.